Hello, my beautiful people, and welcome back to another episode of Tabar's 2 Cents, the podcast where we ask the experts to share their story on how they got to where they are and what sets them apart from the competition. And we like to have a little bit of fun while we do it. Today's guest is a very special one because those of you who know me know that I'm heavily involved in pre-construction real estate sales. Myself and my team sell hundreds of pre-construction properties per year, and I've given you lots of advice on how to get the best deals, whether it's being first in the door, buying in AAA locations, or looking out for amazing incentives. But today's guests will talk to us about what happens before I even come into the picture. Before there's a sales office, before there's a floor plans, before there's a price list, well before all of that. He'll share with us how the sales office got there, how his organization is a part of it, and how you as an investor can get involved. So without further ado, I'll introduce my guest, Barry McCullough. Barry is vice president in Greybrook's private capital market groups. He's responsible for building and managing relationships with investors associated with some of Greybrook's key channel partners and works closely with management on strategic initiatives. Barry has over 12 years of experience in the investment management industry, most recently with TD Asset Management, where he worked closely with portfolio managers across the country, serving high net worth individuals, foundations, and institutional clients. He holds an MBA from Rotman School of Management at University of Toronto with a specialization in real estate. Barry, first and foremost, before we get into the nitty-gritty, how you doing, my man?
Good, Anthony. Glad to be here. Thanks for having me.
Are you as busy as we are, man? This real estate market's just insane, man.
It's a complete 180, I would say, from what the early days of 2020 had felt like, but it's nonstop. It feels this year for us, for sure.
For sure. So let's dive right into it, man. Who is Greybrook and what do you guys do?
Yeah, so essentially Greybrook's a private equity firm that really we focus on land development and specifically residential land development that could really encompass projects all the way from infill townhome developments, stacked towns, larger kind of master plan subdivisions, mid-rise, high-rise condos, for example. Obviously, those more so kind of in the downtown core. And then also in certain markets in the U.S., we focus on purpose-built developments to a large degree. And we can talk a little bit about our society platform as well. So I would say it really spans the gamut of different flavors of residential real estate. And essentially what Greybrook does is we identify high potential development sites, essentially raise capital. Or when I say us, I mean us and Greybrook's investors, and partner with developers on an equity basis to essentially purchase those sites, bring those lands through a planning and a development process, get into a sales and marketing process as well, and then ultimately construction and ultimate delivery to the end buyers. That's where we make our exit, is really at the completion of the project.
Wow. Okay. So essentially, you're finding locations that you feel would be a great site for a condo project. You raise funds for the developers and basically watch it all happen.
Yeah, I'd say much more than just watch it all happen. We're not really interested in just raising capital for the sake of raising capital. Obviously, that's sort of a core function of the business, but we're really an active asset manager, straight through the entire duration of the project. So it's more than just, here you go, developer A, here's $20 million, let us know how it turns out. Rather, we're in there, alongside them, shoulder to shoulder, for the duration of the project. There's a lot of, insight and knowledge that we bring to bear as well. So it's definitely a very active process from our perspective. Not so much from the investors. It's obviously a very passive, hands-off investment. But internally, with us as a firm, we're in there from day one all the way until completion.
What kind of developers have you worked with in the past? Maybe you can share some names with us.
Yeah, of course. I would say names that are, for people that are in Southern Ontario would be probably fairly recognizable. Tribute Communities, Fieldgate Homes, First Capital Realty is a partner of ours in some projects that we have in the Yorkville area near our office. In the U.S., we work with a really well-heeled developer called Property Markets Group, or PMG. They're really top of their game as it relates to luxury buildings, purpose-built apartments, and part of our society kind of co-living platform as well. So really, we seek to partner with developers that really don't need our equity or don't need our capital. They're very deep-pocketed, strong balance sheets, kind of tier one developers in and of themselves. But really, it's the execution, the bench strength, so to speak, the history that they have that really makes us or makes them attractive to us, and vice versa.
So, just dumb it down for me. If you're finding developers that don't need you, why do they need you? Why would they have you involved?
Sure. Well, development is a very capital intensive business, as you can imagine. Obviously, tying down a development site for a number of years. If you're a developer and you can put up 100% of the capital for 100% of the returns, maybe you're not able to scale. You might just focus on 2 or 3 projects and watch those come through to completion. With our model, the way that we structure it is that investors would put up the majority of the equity. The developer would put up the balance. So there's a bit of a split in the equity contributed. And then at completion, essentially, the investors are splitting profits, usually in a 45-45-10 fashion. So 45% to the investors, 45% to the developer, 10% for Greybrook. Essentially, that's how we earn our revenues as a company, is on a success fee basis. So, if you're a developer again and you can put up a minority share of the equity for an outsized or disproportionate split on profits, it gives them better return on their own equity. They have the ability to then scale and do more projects and kind of keep their machine humming, so to speak. And then, like I said, we kind of sit at a bit of an interesting position in the ecosystem where, rather than just being a developer with our pipeline entirely, we're kind of at the intersection of the top developers in the business and tapped into their pipelines. And there's a lot of real-time knowledge that we can bring from active projects in our portfolio to how we underwrite future projects or help co-manage other developments. So I'd say that intellectual capital and that true partnership is, I would say, probably just as important as the capital itself.
Sure, it makes a lot of sense. I mean, I read Robert Kiyosaki's Rich Dad Poor Dad, and they say using other people's money is one of the key ways to building wealth. So I mean, you guys have surely figured it out on a huge scale.
For sure.
Now, how do you source particular locations or opportunities? What drives you to choose some plots of land over others?
Yeah, I would say, thematically, if you look at sort of Canada, just at a very macro level, Toronto, and when I say Toronto, I kind of mean sort of the GTA and kind of the greater Golden Horseshoe, so to speak. That's really, our backyard. It's where we see the best long-term fundamentals as it relates to supply or the inability of supply, rather, to really match a strong and persistent demand that we've seen for 5, 10, 20 years. So that's obviously one of our main focus areas, and it's where the majority of our investments are in the GTA in Southern Ontario. You don't really see those same characteristics in other markets in Edmonton or Calgary. You do see it to some degree in Vancouver as it relates to like land constraints, but at a macro level, that's where we kind of focus on in Canada. In the US, as I said, we have a little bit of a different focus, more centered around purpose-built rentals. So a bit different asset class, a bit different drivers on that. That's where you're looking at, which cities have a lot of runway ahead of them, right? Not necessarily your New Yorks or your LAs of the nation, but more, not to call the mid-market cities, but we just did an acquisition this year in Denver, one recently in Atlanta as well. Ones that have a lot of jobs growth, population growth, and from a macro fundamental perspective, really well lined up for a purpose-built rental type of product.
So how many projects do you have on the go right now that an investor could look at or take advantage of?
Yeah, we have one that we just launched last week, actually. It's a large low-rise development up in Markham. Historically, we'll usually have one open at a time. Sometimes they do overlap. And really, it's just a function of us sort of being quite selective in our acquisitions. Sometimes it's between 4 to 8 projects per year on average. Obviously last year with COVID, we sat to the sidelines to a large degree, just with all the uncertainty that was out there in the first half of the year. So it was a bit of a quieter year for us. The pipeline is certainly growing, and the vast majority of opportunities that we see, will pass on at different points in the cycle for a number of different reasons. But typically, I would say if we have 4 to 8 per year, they're usually kind of released one after the other. Sometimes they'll overlap as well.
I completely understand that, man. I mean, with all the cranes going on in Toronto right now, I mean, I don't particularly work every single project that comes across my desk. So I can definitely appreciate that. Now, Are Canadians able to invest in the U.S. properties as well?
They are, yep, and vice versa. Americans will be able to invest in Arcadian projects. Obviously, there's certain criteria that investors need to meet, whether they're Canadians investing in Canada or the U.S. But from our perspective, it just offers Canadians a chance to diversify their real estate holdings, right? So they might obviously have their primary residence in Canada, maybe a couple of rental properties, for example. This gives them a really easy, hands-off way to gain exposure to a different market in really top-tier North American cities, without having to go and do the brain-damaging process of buying a condo, getting a property manager, dealing with taxes and reporting with the IRS and stuff like that. So it's been quite popular for our Canadian investors to add some U.S. exposure as part of their portfolio.
So if I was talking to somebody who's never heard of you before, is it safe to say, is it fair for me to say, investing with Gradebook is essentially like you're investing with a developer? You're a part of a group of people who are buying a piece of land in order to bring it to market. Is that a fair way to say it? Yeah,
that's a pretty good approximation. I mean, at the end of the day, the investors are just proportionate shareholders, essentially in the project itself, and they're investing for a share of the project profits that's split with the developer. So it's a pretty good description, I would say.
We all know developers make a lot of money, so that's definitely an attractive.
Yeah, it's been a good model for us and for our investors for many years now.
Yeah. So what's the minimum requirement? Like, if I wanted to invest with you guys, what's the bottom line, and what's the top dollar that you take from an individual investor?
Sure. So the minimum amount is $25,000. Again, we don't raise capital for a larger fund where we would allocate and pick and choose on your behalf where they go. Rather, the investor gets to pick and choose which development projects they want to take part in or they want to pass on. So we keep it at about $25,000, so it's a bit more manageable and easier to build a diversified portfolio rather than contributing, let's say, 50 or 100 at a time. The maximum is really, a function of the sort of financial profile of an individual's household. Part of our team, what they'll do with new investors is they'll set up an investor profile with them, go through a typical kind of know your client process, gather that information, and then from there, we'll look at, okay, here's where the upper band might be in terms of how much might be suitable to invest with us, and kind of divides a plan as to how to diversify and allocate that across a number of balanced projects.
I see. What's the timeline? Can they expect to cash out or to liquidate?
Sure. So I would say on the short end of the scale, probably about 3 years is usually where some of the shorter projects end up. I would say most of ours are probably clustered around, call it 5 to 6 years. We do have some that are approaching 10 years or longer, and it's really pros and cons to each. Again, part of a diversified approach would be to have maybe a 3 or 4 year project, maybe one that's in the sort of 5 to 6 year range, or others that are in sort of the 9, 10, 11 year range. Really, we're always trying to balance sort of a combination of timeline, risk, and profitability for our investors. So to give you an example, if you're looking at a shorter term project, you're in most cases buying lands that are either fully approved or might need minimal approvals work. So you're not necessarily going to get those lands at a very discounted price, right? You're really kind of aiming to capture more so just construction margin on a project like that. Projects where you have, let's say a mid-rise condo or a high-rise condo, that could be sort of 5, 6, 7 years once you look at sort of the planning cycle, sales, and ultimate construction. And then ones like this one that I mentioned earlier that's up in Markham, it's about a 10-year project overall, right? The first essentially half of that development timeline is really budgeted to just going through a planning process with the region and with the city. The flip side of that coin is that you're able to buy lands at a fraction of the value that they're worth once they're approved. So not only are you actually capturing construction margin once you start sticking shovels in the ground, you're also generating a lot of value just taking those lands through the approvals process itself. And they'll tell you that's where the type of projects that get us excited internally has to be appropriate for a person's timeline and when they may need liquidity. So is a 10-year project appropriate for every investor? No, not necessarily. But those that are looking at it as a part of their portfolio, maybe good ones to consider.
Understood. And forgive me for again asking, just because I mean I'm learning a lot from this, and I hope the listeners are listening are learning a lot as well. Are my returns affected by the time that I get in? Like, is it, if I get in later than, let's say, somebody else, would I expect a lower return than somebody who got in like right at the beginning?
Sure, it's a great question. Just to kind of hit back on that, we close the offering at one particular time, so there's not multiple closings, so everybody is essentially coming in at the same time. We don't have subsequent capital calls where we'll say, okay, we'll take 100,000 of your dollars today and then another contribution 6 months later. Really, it's one offering, one closing of that offering, and then from there, part of the way that we structure our projects is that we can't ever go back to our investors and say, hey, Anthony, the project actually needs more equity.
Right.
Your share is $8,000, so chip in. It's actually the responsibility of our developer partner. That's one of the key kind of core and actually one of the most critical things that they put up as part of their obligations is to be the ones that are bridging any equity shortfalls or guaranteeing those construction loans. So from our investors' perspective, it's really just that investment at day one. Nothing else is expected to come in after that point, and everybody would be coming in on the same timeline.
Got it. Okay. And so this Markham project is open right now?
It's open. Yeah, it's closing in mid-December. So
Okay.
typically we'll have 8 to 10 weeks between when a project is launched and when the actual closing date happens. And this one we just released a couple weeks ago.
Nice. Congratulations.
Thanks.
Now, I know there's no guarantees in life, but the best way to know where you're going is to see where you've come from. Now, what type of returns can these investors expect?
Yeah, in the case of Markham, I mean, it's these longer dated projects are where you kind of find a bit higher returns. In this case, we're kind of looking at about a mid-20s on an annualized number return to investors. In most cases, sort of, back of the envelope, we target being able to double our investors' capital in about a 5-year window or less if we can, right? So about a 20% annualized rate. And we've been fortunate to outperform that if we look at our exits historically. But I think that's probably a good sort of number to bear in mind.
Now, here's a little bit of information that I did hear before I actually got you on the call, is that people are able to invest their RRSPs with this?
They are, yeah, which is a little bit counterintuitive. People would usually think it's a bit hard to get real estate exposure directly in their RRSP.
That's amazing to me. Like,
yeah, it comes down to how we structure it. Really, it's it's a limited partnership structure that we use. Essentially, investors that want to use RRSPs or TFSAs or RESPs, really any kind of registered plan is fine. We work with a third-party custodian firm, and they can set up their self-directed RRSP or TFSA account. And then from there, the funds are available to be used in the project. The returns just pay back into that RRSP. And it's actually really effective in that you're avoiding taxes entirely, right?
I can't tell you how many people, like how many investors I come across who would love to buy a pre-construction condo with their RRSPs. And I'm always giving them the same answer. I'm sorry, if you're not a first-time home buyer, you can't buy real estate with your RRSPs. But here you are telling me that you actually can reinvest or I guess redirect your RRSPs into a Greybrook project. Yeah,
and you're coming in on that manufacturing stage of the real estate, right? Essentially coming in at day one in partnership with the developer. So it's a very, very hands-off, very passive way for investors to get that exposure. And when I say hands-off, it's not a matter of not hearing from us, right? We report back to our investors regularly throughout the year. So they'll get updates as to how the project's progressing, how it's doing through a sales and marketing program, how that benchmarks against our initial forecast. So there's a lot of transparency and reporting that our investors get. Obviously, development's not a very lightning fast proposition, but we do want to make sure that investors always stay up to date with how the project is tracking, how their portfolio is doing overall. So it's been a very popular method, I would say, using registered funds to take part. Sounds very, very interesting, and I'm probably going to be blowing up your phone after a couple of weeks. I'll turn my phone off. That's okay. So what's the process for an investor who wants to invest with you guys? What would you have them do? Yeah, so they can reach out to us, info@greybrook.com. We can, a member of our team will reach out to them to set up a time for sort of an introductory call to discuss sort of Greybrook in general. any questions that they might have about us as a firm or a specific investment opportunity. And they'll have a dedicated dealing representative that works with them on their investments. They'll also work with them to get their investor qualification set up, assist with any RRSP or TFSA account setups and transfers and so forth. So first step is just to reach out. We'll start the process from there. And like I said, whether it's for this project or any future ones, we can work with them on that.
Sure, that's great. Sounds simple.
Try to keep it as easy as we can.
Barry, what's your forecast on the real estate market in the areas that you're working on? What do you see happening over the next 10 years?
Sure. Yeah, I think really our view, and I would say my view is probably consistent with the firm's view on that. Over the next 10 years for sure, the long-term fundamentals of Toronto and the GTA aren't likely to change. You might see blips here and there. Obviously, we saw a very dynamic market in the early days of COVID. What we've seen since then is really, I think, a reflection of just the attractiveness of the GTA market. You're looking at interest rates that are potentially raising, but again, raising from all-time lows. So there might be some headwinds in that respect. I think that's going to be offset a little bit with immigration levels that are going to be not only returning to pre-COVID numbers, but actually higher targets that the government has set for the next 3 years. So if you look at 1 million plus newcomers to Canada expected in the next couple of years, the majority of them will ultimately settle in Ontario and a large degree in the GTA. So I think that kind of strong and steady demand side of the equation will hold. Obviously, we've got land constraints with the Greenbelt and Lake Ontario, and also just a process-driven constraint in terms of how hard it is to bring supply to market, which I don't see that changing very quickly in the next few years. So I'd say we're still definitely bullish on the long-term prospects for the GTA. In the U.S., again, we're in different sort of high-growth markets, whether it's Miami, Atlanta, Denver, and we still share that same outlook where those cities, in our view, have a lot of runway ahead of them. You're not seeing cities like New York or Chicago, which are actually decreasing in population. These are the ones that are really being a magnet for jobs and residents. Wow,
that's great. Yeah, I did overhear you saying Atlanta. What brought you guys down to Atlanta?
A couple of things. We've had Atlanta on sort of the target list for a few years now. So the society platform that we're doing with Property Markets Group in the U.S., who's our partner there, again, it's really focused on purpose-built rental developments. A large degree of those developments would have sort of co-living as well, where rather than renting a traditional 1-bedroom or 2-bedroom apartment, you're renting a bedroom within the larger unit, right? So it's not, hey, Anthony, you've got 2 roommates and one guy leaves and now you're on the hook for the lease. That person just signing their lease directly with the building, right?
Wow.
So that's been a very in-demand product type that we've seen in the past couple of years. We started off many years ago in Fort Lauderdale with our first sort of version 1.0 of that asset type. We just recently went through a transaction to monetize and finish the first of 2 towers there. We've subsequently invested in 2 other developments in Miami, both under the Society platform. And then from there, again, expanding this year out to Denver and Atlanta. Atlanta, I would say, again, it's, a little, maybe not very well-known secret that there's a large degree of Fortune 100 companies that have their headquarters in Atlanta. So it's a really big regional magnet for jobs. And also, if you look at just where quality of life is, population growth, cost of living as well, really kind of checks all the boxes for Atlanta as well. So we've had our eye there for a while. Took some time to really find what we thought was the right site in the best submarket within Atlanta and in Midtown Atlanta. It's along Peachtree, which is kind of the Yonge Street, essentially, of Atlanta. So it's ideally located. It's right by like Tech Square, where all the startups and VC firms are. So we just did that acquisition earlier this year, and that one's now off to the races.
That's good. Now, in your experience, do you find that some sites will give you better returns than other sites? Like, do the purpose-built rentals seem to be more lucrative than the mid-rise condo in Toronto?
It depends. I mean, you have to look at return on a risk-adjusted basis, right? I would say, if you look at kind of as a percentage of costs, what you're paying in Toronto and GTA, just to different fees and taxes and levies of various sorts, it's like 20 to 25% of your cost structure. in the US, it's maybe 3 to 5%, right? So you typically have more margin to work with in US developments. The flip side of that is, do you have a higher growth potential in a market like Toronto, which sees, 4, 5, 6% average growth versus, I would say, more inflation-like growth in Atlanta? Probably. So I'd say on a risk-adjusted basis are probably similar. You don't probably have as much volatility in a purpose-built rental as you would in a condo. And your timeframes are a bit more defined in the US as compared to how they are here.
Barry, this has been awesome, man. I really I gained a lot of knowledge, and I'm sorry. Like I said, I'm going to blow up your phone probably after this. Once my people find out that they can use their RRSPs, just the returns that you quoted were amazing. I'm going to call you myself, actually. So
we'll connect after this.
Yeah, that's great. And I really wanted to thank you for your time today. And I really appreciate it. And I look forward to meeting you, off camera sometime soon.
My pleasure. Great joining you, Anthony. Thank you.
Thanks, Barry.